Ladies and gentlemen, welcome to Creating Tailwinds Podcast by FlightPath Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Greetings, John. How are you? Welcome, sir.
Hey, Jared. My gosh, I had to add a new background in honor of a couple of my buddies. I passed a birthday and I got some well wishes, and so in their honor, some of the guys from the old squadron from a very long time ago in the Air Force, this is for you guys.
I love it.
Little memory lane there, but
That's awesome. That's cool.
Gosh.
Great shot. Great picture.
Riding an airplane going to riders on life insurance contracts. What do you think?
Riders on life insurance. Well, hey, before we dive into that, we're creeping up on Thanksgiving. I just want to mention how we've been doing this podcast now for almost a year. The feedback we get, the folks that respond are amazing. I just want to say how thankful I am that we get to do this, that we get to get out and spread the word, but also that you put up with me on a daily basis and your patience with me. So thankful for you and in this time of thanks for season.
You know, Jerry, it's funny. Sometimes we look right past the most obvious things that we should be the most thankful for, and that couldn't have been more aptly put. Thank you. You have been a blessing in my and Antonette's lives and our family, and I've learned a ton from you. Believe it or not, those out there, Jared is a wealth of information. His insights are spectacular, and I am very grateful to have met Jared and his family, and I wish you, Jared, your family, and all of our listeners out there, very happy Thanksgiving. Thank you.
Yeah, thank you very much. Yeah, it's you got to have the right mindset, right? Which is never stop learning, never arrive at the destination of learning, and I'm trying to be a student of that.
And begin with the end in mind.
And begin with the end in mind. Well, I love it. Well, we picked up at the end of the last episode, said, hey, let's start off with riders. So what, maybe I think you laid the groundwork last time. I'll do my best to lay the groundwork this time.
Okay, have at it.
So in terms of riders, we're talking about policy add-ons. So last time when we were talking, we talked about the base of the policy, the PUA of the policy, what the dividend, we just kind of glazed over the dividend, but that was a previous podcast. And then the cash value, kind of some key aspects of some getting to basics. And so if you have a base policy, regardless of whether you have a PUA rider or not, the rider it's an add-on. It's exactly what you would think of with a rider. If you're up front driving your car and I'm in the back, I'm a rider. I'm just an add-on. You could kick me out at any time, right? So there's all kinds of different, or add, possibly, or additional, right? Yeah. So there's always a lot of different options. It depends on which company you're working with, what their riders are, what they're described as, what the benefit is. Is it cost? Does it cost the client or does it not? Is it just automatically included, or is it something that you do have to pay for to achieve that benefit? So I think we'll use that as kind of a starting point. How would you build on that?
No, I think that's set up perfectly. Yeah, you have the base of the contract. Even a PUA is a rider because it's optional. Anything that's optional is technically a rider, right?
Yep.
And so there's some riders that you have to pay for outside of the contract, the base contract, and there's some that are embedded that come with it. And those are some of the gems that people don't realize just how powerful they are.
That's right.
So
maybe we can start talking about some of what those options are so that as clients consider how they're going to custom make that policy for them, when they reach out and we talk, we're going to talk about some of these different options. You may have had a little bit of education from our podcast already and be very well informed so that you're, showing up saying, I'd like this one. I don't like that one. Can you tell me a little bit more about this? That would be probably a main goal if we're listening to this pod. Am I saying that right?
No, you are. And just so people know, there are some of the riders that exist outside of those that are included in the contract. It's a good idea if you're even thinking about that, and we'll get to like the child benefit rider. If you're even thinking about that stuff, get it in there now because you might not be able to later because that's got to be approved down the road. So just a word to the wise.
I love it. Well, since we started with PUA riders, that's a pretty important one. That's a common ad that we're almost always including in an infinite banking contract. What what are some options on PUA riders? What do they look like? Do we want to talk about those at all?
Well, I think last time we talked about dividends, last podcast,
Yeah.
and
Yep.
so for PUA, the PUA is nothing more than the same. It's the same product as the base. It's just an optional component. So
Yep.
there are many different variations on PUA and how you can build it, and we hit that as well. Whether they're level, the options available for
Yep.
exercise of those PUAs. So that's a whole nother, I think, podcast. And so if we're going
Yep.
to cover
Sure.
riders, rather than get into the details on PUA, we could talk about some of the others. And these vary by company. Every company has their own little
Yeah.
twist to things, and the rules are
Sure.
different. So what we're saying might not apply if you're looking at a product from a different company. For instance, we try to cherry pick from the very best contracts, the very best companies that we find out there. That's how Jared and I operate. We're always going for the highest hanging fruit, and that's who we do not use lower tier contracts.
And
So
and while we're there, that
yeah,
includes high Comdex scores, great financials,
right,
continuously paying dividends over the course of more than 100 years.
right,
Just kind of a brief synopsis of what's included in that decision. Uh,
yeah.
recourse versus non-recourse, another thing we'd like to consider. Those are all going into the factor. So sorry I cut you
Right.
off.
Oh, not at all. So let's take one. There's one, and this could be called different things by different companies, but one is an accelerated death benefit plus rider. What
Yep.
is that? Covers three basic large categories. Covers specified medical condition. There's a list of medical conditions that would qualify. Things like a coronary heart angioplasty, where you have to have a bypass myocardial infarction, which is really big with the spike protein people. This is covered under this thing.
Yep. Yep.
Um, the chronic illness, if you have something where you can't perform two of the six activities of daily living for 90 days, this thing can kick in.
Yep.
Terminal illness, if a doc says, look, you've got 1 year to live. Sadly enough, that unfortunately is the case with some people. It's actually a case with all of us at some point in our life. But
Yep.
these are when these riders kick in, and they offer an enormous backstop for you. They're not, they are almost like long-term care-esque benefits, but it's not a
Sure.
long-term care product.
Yep.
But let me hit something real quick here, Jared. There's this piece on the cost. This is on Medicare. It says
Yep.
Medicare only pays for long-term care if you required skilled services or rehab services care, and usually for a limited period of time. Medicare does not pay for non-skilled assistance with activities of daily living, which make up for the majority of long-term care services, putting the burden of cost on you and your loved ones. This fills the breach in that
Yep.
capacity. Really important to understand how powerful it is. And
Yep.
you get that as part of the contract. We didn't even talk about this stuff because we're doing IBC.
Right. That's right. So this is included at no
It's
cost as a
it's
part of the
included.
the whole life contract.
Yes. Yep.
And so because that's included, really maybe a recap of what you're saying is that you do not have to rely on Medicare or the government to provide your long-term care
Well,
or
they
to
won't.
have correct because they're not going to. So you don't have to rely on them or your personal savings because
Correct.
you have an option that is built into a part of this contract. And part of that, what that option is allowing you access to is you're getting access to an early portion of the death benefit or what
Bingo.
would pay when you graduate. You're getting access to a portion of that while still alive. So
Mhm.
again, while not a long-term care product, there is a gap that it can serve to fill in the meantime.
Well said. Yeah,
Okay. Yep.
absolutely. It's not just cash values. I mean, we're all about cash values in these contracts
Yep.
because that's how we
Yep.
operate. We do our banking with it.
Yep.
But this goes so far beyond that. Nobody wants to go there. I sure don't. But if I ever had
Sure.
to, it's pretty nice to know that I've got that as a backstop.
And
So
you said
that,
those were broke down into three different categories: terminal illness, specified medical, and chronic illness.
right,
Got
right.
it.
Those are the three biggies. Now, and you can drill down if anybody wants specific information on any one of those categories. Either Jared or I would be more than happy to get more granular with you. But
Sure.
there's
Sure.
a lot more there than just that. It just as an overriding children's benefit rider.
Yes.
You thinking about getting married, young kids especially? throw a CBR on there. They're cheap. It's just not a very expensive thing. But what it does is it gives you guaranteed insurability for not just one of your children, if you have children, as many as you have. All of them are
That's right.
guaranteed.
That's
And
right.
there's formulas for all this, but with one company, for instance, the max is $20,000 that you can convert that at age 20, I think it's age 23, and you could put a rider on this thing, which is called a guaranteed insurance rider, another option. And you could parlay this thing over the course of their life. There's gates every 3 years beginning. I think it's at 23 goes to 46. But you can actually build $280,000 of guaranteed life insurance for every one of your kids. It's phenomenal what you can do. Future planning, you can't beat this stuff. And that's just one company, Jared. There's others that we deal with. Talk about some of the other options out there on the child benefit.
Yeah, I mean, a perfect example of how these are structured differently for different companies, right? So, like one of the other companies may have a child rider where the maximum is $25,000 in coverage,
Right.
and yet at 24, that can be converted to 5x whatever the policy is. So you could turn, a small amount of coverage. Obviously, we never hope that anything happens to a child at
Right.
that age, but there's a small cost for a small amount of coverage for a child up until they're 24. And yet at 24, you have the option to 5x that policy into a permanent product. You know, what
Yeah.
more of a perfect way to launch one of your children post college, just getting started being out on their own. And now
Right.
you have the opportunity to offer them 125,000 potentially
Yeah.
permanent life insurance. So again, it's just the different options, right? This is not an added benefit that's free, yet for a small cost you could add the child rider. The child rider is a little different at that company than maybe, let's say, what we'd call OPI, or the option to purchase additional insurance.
Right. Right.
For me personally, I really like to include the OPI on juvenile policies.
Yeah.
So if you have, a grandparent show up that wants to buy a whole life policy for a newborn, that is very common. Yet if you add an OPI rider, or the additional to purchase additional insurance, option to purchase additional insurance, there's a couple of gates on that setup throughout,
Right.
their 23rd up to their 49th year, where they now have the
Right.
option to add additional. Now there's max limits, there's max conversions. You have to participate in some of those in order to allow the conversion to happen. Yet what's been unlocked is the ability to guarantee permanent insurance regardless of what that health is at that time throughout those
Right.
gates.
Which is why it's so important to share with your practitioner, share with Jared or share with me, or if you're dealing with somebody else, share with them. Don't just talk about today as a snapshot. Try to look down the road because it matters what contract you go to. One company may be a better fit. I mean, that's
That's
the
right.
whole point of doing a good client intake, finding out not only where you're at, but where you want to go, what your
That's
dreams and
right.
aspirations are, because we can build to suit. I mean, this is a
That's right.
custom home. This is you want to build a grade or do you want a custom home? We want to build you a custom home with the assets that you have available. You know, there are riders out there for a spouse. Let's say your spouse doesn't have life insurance. Something happens to you. Well, there's a guaranteed spousal conversion contract. It's a survivor purchase option rider. There's so
Yep.
many different combinations, permutations. It depends on the company. So have that conversation as to what's important.
That's right. Yep. One of the other riders that shows up as an option that this one does carry a cost is a waiver of premium.
Yes.
So you have the option to add this to a whole life contract, at which point, if you were to become disabled or unable to do your job, lose your speech, lose hearing in both ears. Again, these are some of the items. There's a whole laundry list of check
Right.
boxes. But if you were, one of the key ones is if you were unable to complete work.
Yeah.
If you lost the ability to complete work by a natural disease or a cause, um, these would be some ideas where if you had the waiver of premium rider, now the insurance company will pay your base premium. They won't pay your PUAs, but they will pay your base premium and consider your contract still in force and still active. They cover that cost on a yearly basis as long as you remain disabled. What's your
And that's
experience with that?
well, no, exactly right. And again, it's different companies do it differently. That's one company. Another company will calls it your primary occupation. So on their rider, if you can't do your primary occupation, you're an airline pilot and you lose your class one medical and you can't fly as an airline pilot, this thing can kick in. So
Sure.
pretty important. But it depends. Every company has their strengths and their weaknesses, and so that's why it's important to do a good series of questions and again, where you're at and where you're going, and be
That's
very,
right.
very granular with your practitioner so that we can build you the best product.
That's right.
Yeah, absolutely right. Well said. Since we talked about waiver of premium, it isn't for the duration of the contract. Some are 60, stop at some stop at 65, and
Good
it
point.
just covers, as you said, the base, and then some of the riders, like one company will do everything except the PUA. So the PUA
Yep.
is not included in that guaranteed premium. But
That's right.
let's say you're 62 years old. Do I want waiver of premium? Well, that covers my base of the contract. And there's another waiver of premium at some companies which cover the term portion. So if you have a coverage for waiver of premium on the base and on the term, you're only going to keep it for the next 3 years, 4 years, because when you hit 65 at that company, it's no longer valid. So is it an expense? I look at, all right, is there enough in this contract? Somebody does a big dump in. There's plenty of cash value to cover it if I need to. I'm not gonna use those dollars there. So
Yep.
everything has a place.
Worth the
It,
discussion.
yeah, you have a juvenile
So,
contract. You can do
yep.
waiver premium on a juvenile contract. Might
That's
be a
right.
real good idea.
Sure. Yeah, you
Just a
have no
thought.
idea what the next 65 years will bring.
You sure don't.
That's right. Yep.
Oh my goodness.
Well, maybe some of the other ones, one that's typically included at no cost is the premium deposit fund.
Yes.
Uh, that there's two different ones, or at one of the companies, there's a couple of different descriptions at the other company. Again, not to get into the specifics or in the weeds too far, what these are typically offering is your ability to deposit multiple years worth of premiums, almost into like an interest-bearing account. Like you're going to generate a 1099 for the interest that they're
Right.
paying you at the end of the year,
Right.
but if you put this into a premium deposit fund, you know, maybe maybe come up with a better description of why this could be applicable. Maybe you came along a windfall and you want to put the next 5 years worth of premiums into this premium deposit fund.
Right.
You pay those 5 years worth of premiums. Maybe you're paying $20,000 a year. You write them a $100,000 check. At the end of year one, they take the next $20,000. At
Right.
the end of year two, they take the next $20,000. But the balance that was there is going to be interest bearing. So they're
Yeah.
going to, it's just like it was in a high yield savings. So you can generate some interest along those lines as well. Really, where that becomes beneficial is for someone that just doesn't want to think about it. Maybe they had a windfall, or maybe they had a death benefit. They had something where they inherited a large a portion, and they
Yeah.
just don't want to think about it. It's hands off at that point. Um, what would be maybe a different description of that?
No, I think you handled that fine. I wouldn't add anything to it. I think that's very, very well said. Um, the whole point of the discussion is we were going to cover all these different riders. We can't cover them all,
Yeah,
obviously.
that's right.
Every company's got their different take on it. One company's got something called an IDO, index dividend option. It's a rider on dividends. And so you could
Yep.
literally, and we're kind of skipping around here, but the
Yeah,
point of
yeah,
this is just kind of a free flow. But
that's right.
the IDO is intended for somebody to say, hey, I want participation in the market. We're like, no, we don't do markets here. We do
That's
safe
right.
money. Well, you could take your dividend and you could cut it. You could go 50-50. You could say, okay, I want 50 that would benefit from any rise in the stock market, and you could take
Yep.
50%, which would pay a fixed amount. And so I got a guaranteed amount. I know I'm going to get on that 50%. Well, if the stock market dumps that next year, you're getting zero there. But if it takes off, you could conceivably double your dividend income.
That's
So
right.
if we can design this for risk tolerance too. If
Yep.
somebody wants to be more aggressive, God bless you, we can do it. But what we can do is we can guarantee you're not going to lose a penny. That's what we
That's right.
can do. And we
That's
love
right. And that's
that.
because you're in that option, in that rider, you're only playing, I should say, with the dividend. And I think
Yes.
they're trying to catch that bait of the indexed
Right.
funds or the IULs that are out there,
Right.
where we know that those funds can actually cavitate themselves because more than just the
Right.
dividend is at risk. Yet they're kind
Yes.
of going down that other path of saying, hey, we're going to allow you that indexed option, but we're only going to allow you to play with the dividend because we understand you want that slow get rich slow
Right.
scheme of the whole policy. So
Exactly.
you kind of get to weigh both options there on that, right?
Yep. And what's interesting is I've done both in my contracts. I've tried it out just for
Sure.
grins. And
Sure.
I did a 50/50 on one and I did no IDEO on the other. And honestly, they're pretty close. They're
Yeah.
pretty close to the 50/50. Now, if I went 100% in the IDEO, probably would have made a little bit more in dividend, but I'm quite happy because it's not about making money on the dividend. It's
That's
about
right.
not paying interest to somebody else with your own money. That's the whole
Yep.
point. So uh, the option is there. So the whole idea was to kind of treat at a high level all the different kinds of not dividends, but riders that are available to
Yep.
you inside of these
Exactly.
contracts. And they vary greatly from company to company, but they're competitive. So they try to follow each other still.
That's right. Yep.
They offer the same mix.
And maybe one last one that's pretty important that is also considered a rider that we've talked about a lot in some different pods is just the term rider. A
You
lot of
bet.
times, a lot of times when we're creating these for a high cash value up front, you
Right.
have to put some sort of a term rider in there to make sure you don't mech the contract. So those are
Right.
still riders. Those are additional add-ons. This one's going to carry a cost on purpose so that we don't mech it. And that's another thing that's a rider. Again, they can come and go, they can change in size and value, but that's also a rider.
And sometimes we put them on there, even though we don't need perhaps that much for
Yep. Yep.
the mech. Why? Because what if you see your income growing and you're not ready to do it now, but you'd like to do it in 7 years, perhaps.
That's right.
As I've
That's
got a
right.
company, the company is growing. Got one, it's 22% growth. I mean, the guy's killing it. So 22% year over year growth. Well, 7 years
That's right.
down the road, he wants a robust policy capability that he can build. You can do it.
Where you've built the
So
room in there. That's right.
build a room. You build the
Yep.
bucket the size that you need. And then
That's right.
as you fill that bucket, now you're ready to build the next one. You make a system of policies to
That's
handle
right.
the things that you finance in life. It's
That's right.
quite powerful. Yeah.
I love
So
it.
what else you got? You got any more on riders or
We could probably go on for another hour and a half and start getting into the
we better not?
granular. We better not. We better pull it back. Yeah, I think the really important part to take away is that some of them cost, some of them don't. They're all optional. Um, Not a lot of them, are required. Yet some
Right.
of them are going to become very, very much needed in terms of protecting the contract. There's going to be some that we're like, hey, you're really going to want to consider this one, and others we can have a discussion on. So it all comes down to creating that specialized home, like you mentioned.
Yeah, you want to put it into airplane terms. You want to create energy and to control
That's
your
right.
energy. Just like that picture behind me shows, you've got kinetic and you got potential energy. So you always want to make sure you're on the front side of that curve, not the back side of the curve for the pilots out there.
That's
And
right.
Jared is quite competent at building that exact scenario for you with your portfolio. What
Love
else
it.
would you like to add, Jared?
That's it. Closing it off for today. Another great episode. Nearing the close of 2020, 2025. So it's been a
Hard
great
to
year so
believe.
far.
It's been an
Crazy.
awesome year. Thank you.
Yep.
Thank you so much, Jared. Thanks for all your hard
Awesome.
work.
Thanks, Sean. All right. Well, signing off. Have a great day.
Have a great day, Jared.
We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.